Thanks, Rich. Thanks, Dan. Basically, I just want to start with this slide here. This is a slide that Dan and I use when we do our workshops, and it just helps address that whole question of why do I need a marketing plan? And simply for two things. One, without a plan, it's difficult to make pricing decisions, let alone evaluate your success. If we don't have a roadmap, if we don't know our destination, there's no way we know when we get there. And then obviously, too, secondly, is fear and greed. These are very powerful emotions. Uncertainty is attached to that whole thing, too, and they affect our decisions. And so often fear, greed, and uncertainty cause us not to take action and cause us to miss opportunities. And this is why we want to have a marketing plan. And I gotta move it. There we go. One of the things we talk about when we do our pre-harvest marketing plans, we break it down to about 7 key principles. And the first 2 are, how many bushels do you want to put in that plan? And then 2, how many incremental sales will you make? And we had a question as part of all the registrations. Let me read it here. How to incorporate crop insurance into marketing strategies, specifically fall planted wheat. That was a question by one of the people who signed up for this webinar. Typically, what Dan and I do in our workshops is we address this as part of number 1. How many bushels are in your plan? We got to determine how many bushels am I comfortable selling pre-harvest. And so we suggest people take a look at their crop insurance. Let's just say, let's say I've got a 40 bushel APH on my wheat. And if I'm insured at 30%, or at 75%, then I've got 30 bushels per acre that I have insured. And that even if I get wiped out, that will be replenished. I'll get repaid for that. And if I'm using a revenue product, it'll actually even adjust price. So it'll make it easier for me to go out there and buy those bushels if I need to. So that, to me, probably represents maybe the max that we might be willing to use. We throw that out there as a suggestion, but that's typically where we bring in how to bring in your crop insurance with your marketing. The other part then is how many incremental sales. Like I say, if we have 40 bushels, APH insured at 75%, that's 30 bushels per acre. Over 1,000 bushels, that's 30,000 bushels. How many increments do you want to make those sales? And you may decide you only want to price half of that APH. And so now you're down to 15,000 bushels. How do you want to break that down? How many increments do you want to make those decisions in? So that's 2 things. 3 and 4, though, are probably the most important ones. Price targets are the prices that we want to take action. Typically, we would suggest you set them at incrementally greater levels. So we start our plan, and our first increment is somewhere pretty close to what prices are available at that time. And then we incrementally set those things higher. And that serves us well if we're in a market like last year where prices were increasing, right? It gives us targets that as we don't get in too much of a hurry, we wait for prices to come up to those targets that we already had set. As opposed to that, we've got number 4 there, decision dates. These are dates you will take action regardless of price. This helps us in years like this, where we're actually not hitting any of our price targets. And in fact, we're seeing prices decline. Number 5, don't price below your estimated cost of production, especially on this pre-harvest phase. We don't want people pricing at a loss this early in the game. Number 6, catch up. Right? If we pass a decision date due to low prices, and we're seeing that in feed grains, make catch-up sales if and when prices rally. And then pricing tools. Use what you're comfortable with. And if it's a more advanced type strategy, maybe throwing in some options, work with your broker and assess your risk and your willingness to take a little bit of risk. And later on in this presentation, I'll touch on some things that we might look at doing in the post-harvest phase. A bull spread, for example. Definitely you want to work with a broker if that's something you decide to do. All right, so what do I want to do today? I want to do 3 things. 1, I want to review progress of our pre-harvest plans. For anyone who's new to this, typically what we do, Dan and I, is we kind of create a plan and we just kind of chart how that thing's working throughout the year so far. I want to examine some post-harvest wheat alternatives because, here we are. Harvest is starting in Kansas. I know I talked to somebody today and they're just waiting for things to dry out and they're going to get going. I know there's been some bushels cut also. So we are at the harvest phase. It's time to start pivoting and think about post-harvest alternatives. And then the third thing I want to do is turn this thing over to Dan and hear what he's got to say about where the market's going. By and large, 2023 pre-harvest marketing has been a year of defense, right? In this declining market, really, if you look at all the grains, wheat, feed grains, and soybeans, we have seen prices declining since we initiated our plans. We're not hitting price targets. Instead, we're trying to identify opportunities within these intervals, right, within these increments of our decision dates. For some, prices have often been below our estimated cost of production. Again, I'll run through an example, but that's where we are right now in corn, I would argue. And it's limiting our progress. We're not getting the sales that we thought we would do. But that's, hey, we created a plan, we're going to follow the plan. And if that means we don't price it all, we'll wait till post-harvest. And I think I got a question there. Are you covering your costs? I think it's very, very important. We don't want to get rushed into pricing grain pre-harvest. That's below our cost of production. So here's our pre-harvest feed grain plan. I think in the handout, I won't go through them, but in the back of your handouts are our outline plans. But I just want to see where we're at. January 1 is typically when we start. December corn futures were 607. And as you can tell, we have never had a close above that. We've never had a close above it. We got very close there about mid-January. If this is working, I got my arrow over there. We get close to it, but we're not there. So ultimately, we priced our first 20% increment on March 29th at 570. And you can see there, I've got our cost of production range. I'm looking at three kind of target markets: Topeka, Salina, Garden City, kind of covering the state. I've got what their basis is. And this is as of yesterday. Okay, so I looked at this after the close yesterday. Really, we're not seeing a whole lot of change. I think December corn is pretty much unchanged, at least last time I looked. Today, November beans were up a couple cents. Wheat, July was down 5 and March was down 7. But my plans here, I'm just using yesterday's prices. So again, Topeka, that would give us a 521 price. Our estimated cost of production was like 550. And so really the market's not covering this right now. And so where are we? We've got two increments priced. We're 40% priced. Our goal is by now we should be 60% priced. So basically what we're going to do is try to do a catch-up. If we would see some kind of a rally up, say, that 570 area back up to our cost of production, where we think we would cover our cost of production, maybe we do 30% then and try to catch up and then reassess. Soybeans, very, very similar. January 1, November soybean futures closed at 1397. Yesterday we closed at 1239. Our estimated cost of production was $12. And so, you know, Topeka, Salina, Fredonia, none of these markets currently at those prices are offering us our cost of production. Again, I want to say beans are up a couple cents, so we're getting close. Here we've made three prices, or we've priced three times, right? We priced 20% on February 21 at $13.99. We priced 20% on April 15th at $13.01. We saw a bit of a rally then and above our cost of production on May 8th and priced another 20% at $12.72. So where are we? We're 60% priced and essentially on target. Now, today is the 14th. Our next decision date's the 15th. So tomorrow we should have one done. Unfortunately, prices are below our cost of productions. And so, you know, the recommendation is this: we don't price anything unless we can see prices bounce back up to say that 1260 range. At that point, we price 20% and we'll reassess, see if we can finish up any markets or any more sales at that point. On wheat, obviously wheat, you know, if you look at our NAS estimates of production, we're looking at 191 million bushel crop. I think the lowest one in about 30 years for the state of Kansas. It's been a disaster. And depending how bad you've been hit, that's really impacting your cost of production. So I've got a massive range there. October 1, that's when we essentially started. It was 960. We made our first incremental sale of 27% on October 10 at 996. We were able to make a second incremental sale of 20% on May 15th at 898. Ever since then, we've been below our cost of production, haven't made any pricing. So where are we at? We've priced 47% of what we wanted to price, less than half. But we're following our plan. And as you can tell, the market has spent a lot of time underneath, right? Everything here below 860, we've spent a lot of time under what I would consider our cost of production. And so a person wouldn't be making any pricing decisions. At this point, I want to pivot and start looking at post-harvest. When we think about post-harvest price appreciation, typically that's going to come one of two ways, right? From a combination of either an overall increase in the wheat market. Let's say Soviet Union pulls out of the wheat agreement and we get no grain now from Ukraine. That would definitely push wheat prices up. It would push futures up. It would push local cash prices up. The second area that we sometimes see some price strength, price rally, is strengthening in the basis, right? Because even if we saw futures level, we might see cash prices rising to that because we've got to bid that stuff out of storage. And so typically, you'll see there, March will get up there as high as 5% higher as a seasonal index versus where we are in December. So typically we do see a price rise. It's going to come one of those two ways. I'd say first thing we want to do is ask ourselves, what's the market saying? Is there carry in the futures market? And the answer is no, right? Yesterday, July, futures closed at 791 3/4. December was 790. March was 785. Now, again, we're down about 5 to 7 cents currently from those levels, but they're all down roughly equal. So again, there's no carry, right? That deferred March contract, it's lower than where we are now. So that's the market signal that says, sell your wheat. Second question we've got, though, is there any potential for basis appreciation? And on this chart, I've got, this is a slide of an example. But typically we're running right here at zero. And if we look at the March contract, though, we're about 7 cents over, right? Because March futures are at a discount, right? So March basis is 7 cents over. Now, if we go to that circle on the chart, that's a midweek or that's a mid part of February. And if we look at that, would be March basis. Typically, March wheat basis on average is 7 cents under. Currently, we're 7 cents over. This year, we were 16 cents under. In 2022, it was zero. So it was a zero basis, but even all three of those are below where we are. So I would make the case that there's probably not much chance for basis appreciation. Now, could the market take off and we see a return to storage? Sure. But you're not going to get a lot of help probably from basis appreciation. Can I cover my storage costs? Well, it depends on what they are. In the handout, I'm not going to go over it. There's a good presentation on what, calculating what your costs are for storage. And I like to use the 15-year Kansas average. This chart is the July through May 15-year average Kansas wheat price, according to NAS. So, for example, on average for the last 15 years, 2007 to 2021, the average price in July has been $5.54. And as we work our way to March, it's about $6.10. So yes, we see a seasonal increase in prices. Well, let's make a couple of assumptions. Let's say that I have it in storage and I'm going to get a 3 cent per month storage charge. And because I've got it in storage, I'm not selling it, I'm incurring some interest, right? Because I could be using that money. If I sold today, I could be paying off some loans or something like that. At 3.5% interest, this red line represents the price I would need to have to break even. Yes, on average, we're hitting it, we're breaking even by January, and we're actually making some money in February and March if we hang on to our wheat there. Typically, as you well know, interest costs are higher today. And Rabobank did a research study saying it's going to impact the industry throughout. I don't have a link to that study, but they did a study. If we would say our interest jumped up to 7%, I'm not saying that's what your interest costs are, but if it is, all of a sudden now these are the prices I need to get. So we're breaking even on average if we hang on to it until February, and we're making a few cents if we hang on to it in March. Again, another incentive that makes possibly, unless things change drastically here in the next couple of weeks, it makes storage tough. Okay, it makes storage tough. Yes, I'm getting a better price, but if I cover my costs. So what are my alternatives? Well, okay, we can store the grain and sell futures, and that's what we call a storage hedge. But if we're not going to see any storage basis appreciation, that's probably not a good alternative. we can store the grain unhedged. And that's possibly what a lot of folks do. But again, think back to that last slide. That's kind of our storage situation. And so, yes, there's opportunities. We'll have to listen to what Dan says on what our chances are of a good, strong rally. But I don't hold out hope that that's going to be a massively profitable endeavor. The other thing we could do is just sell it at harvest, right? Take our losses, move on, let's go. Let's focus on soybeans. Let's focus on our wheat for next year. The other thing we could also do is this 4 and 5. We could sell the grain and buy a call option, number 4, and that's essentially a minimum price contract. And a lot of times, through our workshops, we found, there's a lot of elevators that are more than willing to do that with you. And in fact, sometimes they make it pretty lucrative. I mean, they'll pay your hedge costs, et cetera. That's something to consider. We'll take a look at that. The other thing you could do is number 5, and it's sell the grain, buy a call option, basically the same option in number 4, but then sell an out of the money call option. So a call that has a higher strike price. Essentially, we're putting on a spread. And as long as prices rise and don't go above that out of the money call, that can work pretty well for folks. And we'll take a look at that. So let's run the math. Remember, these are not recommendations or advice, but these are just some examples. So here's a quick spreadsheet that I put together. You look at A, that's selling the grain at harvest. And again, this is a Salina, Kansas example based on yesterday. Local cash price was $7.92. All right. So if we sell the grain and be done, you got $7.92. B, sell the grain by a call. So we're going to go out and we're going to look at March, right? We're going to sell buy a March call option. And I just looked at a $7.90 because March futures were $7.85. So I went to a $7.90 call, a strike price, and that option was costing me 66 cents. So I've got my $7.92 from selling the grain. I subtract out 66 cents and another penny because I got commission costs. I'm at a minimum price of $7.25. But if prices rise, if we see a massive rally, that call is going to make me some money. Option C, or alternative 3, is sell the grain and put on the bull call spread. Again, I'm getting that $7.92 up front. I'm spending 66 cents on the $7.90 call, but I'm going to sell a $9 call. So a way out of the money call, and I'm going to receive 34 cents for that. That's what we were getting yesterday. So that increases my minimum price up to $7.58. Okay, so that's kind of the mathematics we're looking at. This is a harvest time example. I'm using today's prices, but a lot of folks are starting to cut or getting very, very close. Again, this only works with tools, only work with tools you're comfortable with, and work with a broker if you're using more advanced strategies like this C, the bull call spread. Again, we want to focus there on those minimum prices. Okay, so the first thing we're going to look at is what if prices fall? Okay. I don't think that's Dan's forecast. I think he's kind of seeing a sideways pattern essentially. But basically, let's see if prices would fall. So that $7.85 futures in March, what if they drop $1 and go down to $6.85? Okay, so where am I at? Well, if I sold the grain at harvest, I got $7.92, so I'm feeling pretty good. If you sold the grain and bought that call, well, your call is going to expire worthless. So you're out to 67 cents and you're netting the $7.25. The bull call spread, same thing, you're netting that $7.58 because all of these calls are expiring worthless. So you got to pocket that 33 cents. You add that to your break even there, and so now you have a $7.58. Now here then, so the next thing I want to look at is what if prices rise? What if something changes? What if it gets dry in the Corn Belt and wheat rallies? What if, just all kinds of things that might push the wheat market higher actually happens? And so from $7.85 March wheat futures today, we see $8.85. Okay. So again, cash price then, if we have a zero basis, cash wheat is at $8.85. If you store unhedged, you're at $8.49. It worked out great. Option A, you get your $7.92 because you sold it now. If you sell the grain and buy a call option, all of a sudden that 66 cents you spent for that $7.90 call, that made some money. And you're actually 28 cents ahead. And so you're at $8.20. On C, alternative C, the bull call spread, you're still, because we haven't gone above $9, that call expired worthless. Okay, so you pocketed that 33 cents. And then you're also adding to that the gain from the other option of 28. And so you're at 853. So in this situation, the bull call spread actually would work better than storing it unhedged without near as much risk. So modest rallies, and this is even a dollar rally, favors the bull call spread. With that, I want to thank everybody. Thank everybody for tuning in. And thank Rich. I want to thank Dan. But I'm going to turn things over to you, Dan. And I'll stop sharing. Thanks so much.
I appreciate talking with you all today, and it just strikes me that in a good number of years where we're sitting at here in mid-June, often is just about the time when if we had good weather in the Corn Belt, that the corn market overall, traders, et cetera, would begin to think that a large crop is coming or become less worried about major problems, and would start to see what's become a not unusual pattern of starting to see declines in corn futures prices heading from here on into the fall, or at least to moderate. Again, there still lots of things lots of time to have to get through all the way through July and August. But if this was a normal year and all the Corn Belt was in good shape moisture wise, no late planting issues, we'd be at risk right now. And you'd couple that with if we had a normal wheat harvest, in Kansas, in the hard red winter wheat areas, that would bring about price weakness too. And in fact, the weakness in the corn market would likely build upon or encourage or take from the weakness in the wheat market with the seasonal harvest coming on, and again from here on into that. There's still questions to be answered, but overall the market wouldn't be worried, and it would also affect soybeans. If we again had adequate moisture, no risk to the crop, we'd be seeing a situation where we'd be looking at risk. But as I mean, all of you that are on this call, again, you're very involved with agriculture. You're watching the markets the same as I am, and you're noting the same issues in that. For the last 7 days, precipitation in a sizable portion of the U.S. Corn Belt, it hasn't been very good. The 3 I states, significant portions of them have been again 10 to 25% of normal rainfall. That's over the last 7 days. Over the last 30 days, even more of that area. And I guess whereas last year we were in western Kansas all the way through extremely dry, well, here the western Corn Belt now has caught some moisture. In fact, some of that moisture that's come affected the last USDA NASS crop production report, in that the moisture that you see that's come into the Texas Panhandle, Oklahoma Panhandle, parts of Southwest Kansas, where wheat was still in a position to benefit from it. We actually saw a little bit of an increase in yields. The issue there will be what acres are still there to actually harvest. So we've got this situation now where I don't think that there are any parties saying that, well, we've got a 1988 or 2012 drought upon us. Again, the general expectation still is that we're coming out of the La Nina time period into a El Nino period, and at least in the Corn Belt, generally that has been a time when we've had okay moisture. So, but so far that hasn't been the case here. In terms of short-term, let's see here. In terms of short-term drought measures, you see a very serious picture. This is as of June 12th, that would have been Monday. very important areas of the U.S. Corn Belt being affected by a short-term drought, and enough seriousness that even the soybean market's paying attention. There was a major jump up in soybean prices happened earlier this week, and that was based on fears of the dryness that's affecting the eastern and central Corn Belt in particular, and parts of the West, especially in Nebraska, affecting corn, yes, but also likely to impact soybeans. The long-term drought objective drought blend equivalent measure, a little more central Corn Belt focused, but on the short-term side, affecting topsoils, you're just looking pretty dry. And around the globe, you can see what that picture looks like in the U.S. Again, kind of a central eastern Corn Belt dry situation, parts of the West and Nebraska. Still dryness down in Argentina, parts of Brazil showing challenge, but not enough to allay their optimism about the size of both their corn and their soybean crops. You look into Europe, not a lot of major problems, although we do read news reports about some crops in some parts of Europe being affected by this. If anything, actually in China, they were anticipating a tremendous wheat crop, and then had deluge conditions, and went in a short period of time from anticipating a tremendous bin buster to basically telling their farmers, yes, it's okay to feed sprouted wheat to your livestock. So a major change in the outlook for the wheat crop in China, and you can see that on India, and that they're part of their land mass. So you can see that part a little bit to the right, to the west, to the east, and those are some of the same areas that were dry last year. And Australia is in full-blown anticipation of El Nino drought disaster mode. And that's just a little bit of hyperbole, but not much, in that you'll see the numbers that they're anticipating for their wheat crop this next year to fall off dramatically. So in light of that, you can see where some of our bids are at. One thing I noticed for corn is that although we still have pretty strong basis bids saying in Garden City, 96 over, and new crop bids 33 over. See that 584 for new crop and 96 over for corn. We've seen a fair amount of weakening, especially in Colby area. Not a lot of strength in a lot of these other places. You do see Hutchinson and Columbus coming in pretty strong. Interesting to watch and see where there's interesting grain sorghum. Grain sorghum bid, if you look at Topeka, have a 10-cent higher cash bid, 10-cent stronger basis for spot sorghum prices than we do for corn. And so in Topeka, is a major export area. So when I see something like that, your ears tingle, and you wonder if we're getting ready to move some grain out. And you see the new crop bids, again, that Topeka area, equal new crop bids for corn and sorghum, more of a differential in other places, although Salina, pretty close, etc. Would say for soybeans, but overall, we've generally seen, as futures have come up, we've seen weakening. It's almost as if the cash markets are saying, futures, you carry the ball now. And I wonder what would happen if futures went down in these areas, and the local demand would come in. Would it raise the basis back up? For soybeans, you can see a fair amount of variation across the state. Strongest prices again in Topeka for spot, and for new crop bids, strongest again, Topeka and Hutchinson. It's interesting to and to see what all is happening there. And then you have the wheat market situation. There's a I hope as we have time here, I'd like to talk about issue of real consternation in the wheat markets right now as you look at wheat being brought into the United States. It's sort of and it's brought into areas towards the fringe as you put down to Texas Gulf, Florida areas, places that are well suited to be a port location or a near ocean location where a mill could take in wheat that they had a good price on from overseas and then take advantage of it. But you can see we've got a fair amount of variation. Salina, hard red winter wheat, 780, 777 in Hutchinson. And some places not even having new crop bids. So with normal, in a normal year, if we had wide coverage, decent crops, we'd be anticipating sitting here in mid-June that, gosh, basis would really weaken right now with harvest gluts. But this, given the spottiness of what we have for actual harvested acres and decent yields this year, that's going to be something to watch for. Let's take a look at feed grain markets. Feed grain. It's telling that we're generally, as I look at the corn market, I'm pretty upbeat, mainly because we've gained about 50 to 60 cents. But the long-term trend sure has been down since last fall. You can see that high of 706 for a weekly close. We've just generally been moving lower. And and Mark, you and I have talked about where we set our price goals. I still see the highs we had back in 2021, 735. That was in May. The high in May of 824 and a half in April, about that again in May. Here we're coming into this May, and this is our low. So the market has certainly been anticipating that things have been moving to the low side, and dry conditions have now got the attention of the market. I would say that if you look at I believe my screen's, I think this is Dees corn. There you go. You can see we've come up for new crop bids, and that's a lot of what we're talking about today. 551 on yesterday's, 551 and a quarter yesterday's close for Dees corn. You can kind of see where we've been in the past, as low as about 490. Recently up to 570s. That gives us some idea of trading ranges in terms of where the markets may go. So here in early May, we looked at whatever information was out there, strong estimates of what yields and production would be over 15.2 to 15.3 billion bushels as official estimates, given early numbers before we started to look at the dry conditions, and we're thinking, gosh, we're going below $5. Well, what's developed has changed that some. I did want to bring up, without getting lost in this, just a little bit of information on the options markets. Not that I'm trying to get anybody to necessarily use these, but there's information here. So if you look at up here in the corner, yesterday's close 548 and 3/4, just about 550. This would be the strike price. So quote, at the money in the blue. And if you were going to protect, if you're going to buy a put option to protect yourself from Dees corn prices falling below 550, 550 minus the 42.5 cents, plus about 2.5 more cents to deal with the broker, so make it 45 cents, you'd be protecting about $5.10 Dees corn futures. And depending on where you're at in the state, if you have a 20-cent basis, you're at 485, 480, something like that. That is not very far. In fact, that's right on exactly what the USDA's current projection is for this new crop marketing year. Another thing to see though is, there's a lot of participation. I'm just showing you one slice of puts and calls. You can see that each one of these open interest numbers is a 5,000 bushel contract. And you can see at $5.50, $5.70, $6 for calls, at $5.20, $5, $5.50 for puts. You can see a lot of participation, a lot of buying. So, and also people, you can ask the fair question, well, how can I just go buy these options, and are they cheap? Well, these things are pretty high priced. When they're high enough price that they're representing a lot of uncertainty in the market. Just thought-provoking. Sometime down the road, we can talk some more about what information is out there and the puts and call bids, just to see where people are putting their money as they try to assess the riskiness of this thing. Okay, I try to watch futures to see what they're telling us at any one time and compare that to any official, say, USD ERS projections that are out there for price. And looking at yesterday's closes over futures contracts, and using latest basis information that's available, you can see that the red line is basically what, in terms of a percent of season average price, kind of the trend we've had in the 22-23 marketing year. Starting September 1, 2022, will end August 31st. Well, that projection, by the time you look at prices being pretty high up front, falling lower, heading into the last several months, about 644. The new crop numbers, again, that's this pretty flat line, not showing hardly any seasonality other than, and this is looking at, Mark, this is tying in with your statement about, hey, things are pretty, we're not seeing any carry in the market. Well, there you go. The future, as we look to next year's futures for the next marketing year, it's pretty flat, except and falling off into the fall. That projection is about 569 as of yesterday. And, so you're comparing that. So the current USDA projection for this marketing year is 660, futures saying about 644. Yeah, in the ballpark. Depends how the last couple months go here. But the new crop bid that USDA had is about 480. Again, that's off that 181.5 bushels per acre projection out of NASS. And I know my friend Doug Bounds is on here. So Doug, I'm not picking on NASS. I'm just saying that given the early information, they projected that on a trained yield, assuming normal weather. Well, now that we've had some weather that's not so normal coming in, the futures are having a different perspective about a 90 cent differential from that early USDA projection. And again, that in fairness, the USDA, they stay with that those numbers generally until they actually get in the field and measure plant information. So as it is, USDA's projection about 480, so below $5 cash price. The futures right now, at futures with a basis assumption, projecting about 90 cents higher. And here's the latest set of numbers. There's that 181.5 bushel per acre yield. The projection, given the acreage numbers that we're assuming, about 15.265 billion bushels of production. You end up with normal reasonable usage assumptions, about over 2 billion bushels carry out, 2.257. Stocks to use markedly higher, about 15-16%, and there's that 480. So here, my own thoughts are, given now that we have this weather issue that's happened in the Eastern Corn Belt, we can still, that number can still be hit if we turn around, get good weather, Eastern and Central U.S. and corn's very resilient crop. It can come in, still hit the 185. My own judgment would be there's about a 1/3 chance of that happening. There's been enough damage that I'm looking more to 177 bushels per acre, or and actually this is 174. I forgot to change the number there, 174. So something instead of 15.265 like the USDA right now has as their projection, something closer to 14.9 or 14.6. And of course, you know, that will bring in, if you use same usage, instead of 2.25, 1.8, 5, 1.6, ending billion bushel ending stocks, tighter stocks to use prices being about 540 to about 610. And I'm not trying to be just a person that gets on a wagon and just hops in and rides with everybody else, but that 177 would be a record high yield, still attainable, of course, and that's not far off of where the the futures markets seem to be projecting. So I guess as we go forward, this will be the issue of the day. Are we at 480 or are we looking at about 560, somewhere 540, 560? And if we go even lower, things stay dry or prolonged amount, then you're getting closer to 11% stocks to use. That's something closer to $6, $6.10. So really, right now, we're watching the weather. So I'll just move quickly through these. There's that yield differential, and the change you'd see in production: 15.2, 14.8, 14.9, 14.6. By the way, I put about a 5% likelihood of that, of the 174 bushel per acre, 14.6 coming in. It just seems pretty early to be banking on that. If it stays dry through the next time we do this in mid-July, then we'll come back and address that. And there's the price differentials. 480 right now projected by the USDA, about that's 35%, and about 540 and 610. Just want to, without I guess bemoaning this, world minus China stocks to use still remain pretty tight. Note that this, when the USDA comes in with its 23-24 marketing year, and that's these numbers out here on the edge, you're showing the crop that'll be harvested in South America in the spring of 2024. So that crop's not even planted yet. So even with anticipation of crop of strong corn crop, you're looking at just a little bit of an uptick in corn ending stocks and a little bit of increase in supply demand. So it just shows that things are tight right now in the corn market. And you can see the stocks to use figure. If we get what we're talking about there, you can see that how much of these, how much we're counting on China to actually have the difference of 314 minus 110 million metric tons. And they do have some stocks, but what quantity, what quality are they in? That's the question. And there you can see what would happen if the projections that we've seen really come true. There's that projection for Argentina. Argentina this year, 22-23. There you see the drought, their production of 35 million metric tons, and you can see the Brazil production of 132 million metric tons this year. By the time you add, so a lot of what would happen next year is that Argentina would get right back on track with its production. In fact, it'd be back to record production. Ukraine, if Antonino Braiaca was with us, she could talk in a lot more informed manner than I can. But this Ukraine issue is no small thing in that you've taken away the production capacity of the world corn market and the world wheat market. So for as much as Brazil and Argentina may run up, they're covering the losses that we're going to institutionalize basically in Ukraine until there's full recovery. And China, here are the China numbers. Hard to exactly interpret all of this, but again, for that 23-24 marketing year, at least for corn usage, not anticipating that red line going down any. Did want to say for grain sorghum, it might just be Dan O'Brien sitting in Western Kansas, thinking too much, but interesting situation for grain sorghum this year. In that, so where do we plant grain sorghum? Well, in a lot of areas where we got moisture right now, and some sorghums probably come in on some failed wheat acres. Like Romulo Lulato in our shop at K-State's been talking about this as something to consider. So we get it planted, and if we do, we've got ample moisture right now for sorghum, and say the 69 bushel per acre that the USDA has projected, 76, 75, 76, and so you look at that option C out there. If the conditions in the eastern corn belt continue in terms of dryness, then likely to be the world will be, there'll be even less grain sorghum or corn available for world export markets, and sorghum could be in pretty good position. So that's the case. You see that that $6 situation down there. I just wonder about pretty good grain sorghum production, maybe a little higher yields, and sorghum benefiting from the unfortunate shortfall that could happen in the eastern and central corn belt of the U.S. And you can see that the USDA's projection for grain sorghum 480 for next marketing year, futures about 571. But note that is a set of tortured lines right there, hardly consistent. So I'll move pretty quickly here. I want to show you on soybeans. Pretty similar picture for corn. Again, downtrend since May. A little shorter term downtrend than it was for corn. Since about March, pardon me, of this year, there's that 1555 and a half, had got down to about 1270, and now back up to about 1420. So we tend to be myopic. We see this recent uptrend. That's pretty good. We're thankful for it if you're a seller of soybeans, but we still have quite a ways to go to get up to the highs we'd seen earlier in the year. Here's for November. You can see that the concerns about planting soybeans, Eastern Corn Belt, US coming in, and that's even with record crop apparently coming in Brazil. We're still seeing this type of a run up here in soybeans, and up to close yesterday at 1239 and a half. We had been up to about 1287, 1288, and much higher, but the dry conditions have got the market's attention. Just to show you quickly here without spending a lot of time on this, you see at the money soybeans, if you're going to November beans closed at 1236 and 3/4 yesterday, 1240 strike price at the money, 1240 futures, 67 cents. And let's again add 2 or 3 more cents, make it 70 cents. So you're looking at a net futures price that you could protect if you bought an at the money put. Again, buy a 1240 put, spend 67, pay a broker, get 70 cents total cost. You're looking at about 1170 as a net bottom futures price right now, but you'd spend 67 cents to get it. But yet, and note, when you look at up and down all these prices, this is all these high prices here, they're representing volatility and uncertainty. That's the going price for someone to bear the risk and uncertainty of movement in November soybean futures right now. And I would note that whereas we talked about this type of a chart for corn and for sorghum, really we're not far off in terms of what the futures are representing compared to the USDA's projection. Current marketing year ending August 31st, 1420 by the USDA, futures projecting about 1412. November new crop beans at 12.10, new crop futures about 12.34. So really pretty close. And here's they are, if there's a weakness in the supply demand balance sheet for beans, it's with dry conditions over there, we still are projecting a record high yield, 52 bushels per acre, almost not quite as far above where we've been as for corn, but still record high. There's the production figure that you'd have. Ending stocks to jump about 120 million bushels, stocks to use move up about 2.6, price drop off about $2.10. So here's some alternative scenarios. I figure at least 50% chance they're right. We haven't even got a lot of that crop planted yet, but if we stay dry, if we get 50 and a half, still a good yield, get 49 bushels per acre. You can see how the supply demand balance sheets are affected. Excuse me. And you can see where instead of 739, we're getting back to where we were last year about, but just under 5%, 3%, instead of 12, 20, 12, 10, 1440, 1550. So what I'm showing you there is a coin flip. Is the USDA right? Well, they might be, but it's still early in their defense that, they make those projections and then weather happens, and it's happened early on here to have been dry. So there's a fair chance that the USDA projections right now are for production are optimistic, and that we could turn higher in the soybean market. We'll just have to watch. And here you can see that. I guess you can see that table I just showed you. Here's what it would look like: 50% chance at 12.10, drop off about $2.10 from last year. But the other 50%, hey, depending on that Eastern Corn Belt situation, largely, we could be at last year's average or better. So let's move on to wheat in the time we've got left. Wheat markets, been a ongoing downtrend since last fall in the wheat markets. Close here, actually the latest close yesterday, where we're trading earlier today, about 784 and a quarter thereabouts for wheat. Again, we're coming into harvest, and you can see for September, I'm looking at September now instead of July, because I want to talk a little bit about options. So they're about par with one another. You can see 790, been some ups and some downs. Have traded up to 9 recently, as low as about 730 in late April, early May. So there you have that. If you have that range, we're coming into harvest, you'd expect harvest weakness. And the thing you'll notice here, those astute options watchers, is that, boy, there aren't, compared to corn and soybeans, there's not a lot of open interest here, not a lot of volume. So you have to be careful about going into that. But just to see what it costs, if someone were wondering about, really worried about price weakness right now here, and how to protect it, September traded at 782 and a quarter yesterday. 785, you went to 785 to match that or come close to it, strike price, 44 cents to protect it. And again, add about 3 cents more, 47. So you're looking at about 740, 742, something like that, as what you could protect. And of course, we're at 782 and a quarter. That's probably not that attractive to a lot of people. Wheat. So what's the wheat market doing relative to the USDA projections? Again, on yesterday's closes, current projection for this marketing year by the USDA is 785, and and that's that shouldn't say current. That's the old marketing year. We switched over. This is now the old crop marketing year. Started July 1st. 785, 885, 73 was what had been projected. Next marketing year, that's the one we're in now as of June 1, 770 projection by the USDA. Futures just a little bit more optimistic, about 785. So not too far off. Futures are a little bit more optimistic than the USDA projections. And you can see 44.9 bushels per acre. There's the projected crop size, exports. Note the weakness in exports from 775 down to 725, down 50 from year to year. And again, this for the folks in Kansas wheat and other people in the U.S. wheat industry have a lot of concerns about this, especially when you hear of wheat being brought into the country by millers. Note 562. We've got these things happening at the same time that this 562 is about as low as we've been for a while. These are tight market conditions for wheat. 30% stocks to use, 30.6. That's for wheat, a food grain like this, that's about as low as we've been of late. Market price 770. So in my myopic view, I see 770. I think, my gosh, it's down $1.15 from last year. Historically, 770 is a tremendous price, but you're dealing with inflated costs too. So note here, this first column, that's USDA's new crop projection, and let's say there's about 60% chance they're right. We've got some other things to consider, some lower yields coming into play. Wondering about what's going to happen with spring wheat. If we're dry in the Eastern Corn Belt, soft red will suffer. I'm not sure exactly what we're going to get out of the field in terms of harvested acres this year in hard red. So that's my litany of excuses. But let's say we have lower production and a combination of factors, Australia, drought, you name it, back up, add that 50 million bushels back in again. So you've got one way or the other. There are a number of scenarios. If 30.6 stocks to use is awfully tight, there are some things in the U.S. that could take us even tighter, and that 770 would be low relative to a lot of these things happening, especially if we get some type of we get a combination of tighter production and exports having any strength at all. So it's you almost have to, you feel like being optimistic and then ducking behind a rock because in the wheat market we haven't had a lot to take us higher, and you've seen that trend. But you stand back and look at these things, there are some conundrums that we're dealing with right now in the wheat market. Planted acres again, so this will be an issue. Note that 74.4% harvested to planted acreage ratio. That's a big deal. Wheat yields, and there's 75% chance by the time you add those scenarios up, USDA is right, but some chance that we could still go lower. There's their projection. See, the 770 is almost tied for the second highest you've ever had, but it's a lot lower than the highest we've had, the 885. And there's those scenarios. So 60% chance that the USDA ERS World Ag Board is right with their 770, but 40% chance that things could move higher yet. The world numbers, world minus China, we have last year with 127 million metric tons, we had a 16-year low in stocks to use, and we're only going to marginally improve beyond that. I realize we have a lot of concerns about wheat, but the world is sort of on the edge, and I guess probably not going to respond sharply higher until a major problem happens. But we're on the edge. There, if El Nino comes in and hits some of these other places around the world pretty hard, then I wouldn't tell people to gamble on the wheat market, but there's concern about adequacy and not further tightening of wheat going on into the next year. That's my own opinion. And you can see the USDA's projection there for this most recent marketing year, and how for world minus China, basically we've been downtrending. That perspective downtrending since 2017 down into 2022, and if everything comes through just fine, we'll gain a little bit and rebuild some on stocks, but that is not a big rebuild in any one year, and it's still counting on all these countries to have decent crops. Just to finish up here, we're just about done. The Ukraine situation, there's the fall off again, and even USDA, which tends to be probably conservative in its projections. You can note the drop off in exports from 2021 to 22 to 23 marketing years, from 18.8 down now to 10.5, so just about 8 million metric tons. And you can see the Russia, the increase it had of about 12 million metric tons, some of it their own crops, etc. So you've got basically a military conflict with I guess a challenging grain accounting as you figure who's handling what. Canada, anticipation of a better crop again in 23-24 marketing year. Australia, they're already dialing in La Nina drought. You can see it with those numbers over here. And Argentina, they're anticipating from their drought this year sharp recovery. European Union, about steady as you go. So with that, I appreciate the opportunity to speak with you all. Are there any questions that we can address, or any points we brought up that you'd like to argue or embellish or inform the point?
Hey, Dan, I just want to say nice job. You talked about the weather a little bit there, and I guess I just wanted to point out, I think, what is it, June 30, we'll have the acreage report. So if we think about what's going to move corn or soybeans, are we going to jump off of that 92 million bushels planted of corn? Is it more, is it less? Same with the soybeans at 87.
Good point.
That could be a major market mover, possibly, maybe not, beyond weather now. And then what is it, August, we'll have our first NASS estimate of yields, but it will only be a farmer survey. It won't be until the September report. So, really, we've got July and August where, this week's weather versus next week's weather is really going to be driving things a little bit. Definitely, that northern part of Illinois, I think, very, very dry. Talked to some guys from there a while back, but yeah, we're going to be in a weather market probably for the next 60 days, possibly, right?
Yeah, and as we started out with, just bear in mind that given what we see right now, lots of dryness. If moisture should come in, then just be aware according to your marketing plan on what to do, because no doubt if that turned around, if La Nina did kick in for the Eastern and Central Corn Belt, the markets would respond. So I guess we're on the edge. We're in a wary, risky situation right now. It's just right at the time when crops are planted. They're dry at the moment. Do they get moisture or not? And here we are. This is the story of the time.
And then, not to put you on the spot, but early, I think we were all worried about, say, North Dakota, northern Minnesota, even South Dakota, because of all the snowpack. From everything I've seen from a NASS standpoint, as far as crop planting progress, it seems like that crop has gotten in pretty good shape. I'm not hearing a whole lot about prevented plantings, which, again,
yeah,
ultimately that could end up being more of a bearish issue if the acres got in great shape. Any thoughts, any comments on that? Are you hearing anything? Because again, if you look at the NASS numbers, boy, it went in great shape, and I was shocked. a little bit more.
Yeah, that was a surprise. I guess I only bring that up with the idea that there's the general dry conditions that we're seeing now, and I wonder how that. And you're talking about the hard red spring wheat numbers up to the north, right? Is that
Well,
what you're
but
talking
also
about?
corn. North
Oh,
Dakota,
corn, yeah, yeah,
is it prevented planting because it was so doggone wet and snowpacking?
yeah.
The crop went in pretty good shape, and I guess and not that I don't want to be that person who talks about somebody they talk to, but I was at a conference and talking to my counterparts from North Dakota, and trying to get at them, hey, are you seeing a lot of prevented planting? And he said, no, it went in pretty good shape. Things dried down and got it in there. And at least my counterparts were thinking that the crop went in. And I guess that's where I'm kind of tossing it back out to you and anybody else. Are we hearing anything differently? Because it sounds like, because we won't get the FSA numbers as far as prevented plant and things until really August also. So it'd be hard to figure out what all did get in, what all did not.
Well, for those crops, I think early on, think about the second slide, we were looking at how much moisture they've had last 7 days, how much last 30 days, and North Dakota, South Dakota, they're both in that dry situation, which would be great for planting. They've been too wet. Now they've got it planted. Where does it go from here? So that's that was part of my thoughts on the spring wheat deal too. I got a question here. Luke Byers asked. I hear you talk about tight wheat stocks, low U.S. production, yet prices begin to slide. Is this a temporary slide, or is this a price slide, just the market coming back to earth from off of long-term highs? Well, I think if our friends from Kansas Wheat were here, they would probably give you 3 hearty cheers on asking that question, because I think that's their perspective too. When you look at I didn't show them here. When you look at the U.S. wheat export numbers and how they performed relative to the last X number of years, we are bouncing on the bottom of almost every year. The only wheat class that has something other than that, or 2 of them, soft red winter did pretty well early, and then it went sideways, and white wheat also has done pretty well, but hard red winter, hard red spring, all just bone low. Hard red winter probably worries about supplies. Hard red spring, in a competitive market, here's where Mark, as you were talking about higher interest rates, largely were impacted, as I understand it, in kind of a macroeconomic sense, by the U.S. Fed activities. And when the Fed was proactive, it would raise U.S. interest rates. Well, that works against us in terms of people buying U.S. dollars with their currency, which is now higher priced, and then going and buying our commodities. And it really has hit. It's hit all these commodities. Really, it's slowed us down some, made countries look elsewhere to go buy, just that didn't have the same currency issues we have, but it particularly hit wheat. So my own thought, Luke, would be that if we had an active U.S. wheat export market, given how tight things are, I think we'd be in a much different situation. But our dragging minimal wheat exports on the one hand, and now news that they're cheaper buys overseas, we're bringing wheat into some of the mills on the fringe, are all working against much cash and futures price strength in wheat. So some would say, well, does that mean we're the buyer of last resort in the world wheat market? Well, with the high U.S. value of the dollar, in a de facto sense, it's sort of made that happen. It's going to be interesting to see where we stand in July. So if that I would wonder if we stay dry in those parts of the country, which in the eastern and central corn belt, that Mark, the price goals you've set, would the market be worried enough for corn and soybeans to get us up to prices that would hit some of those goals? I guess I'm not trying to cheerlead that to happen, but if we stay dry in those other parts of the country, that could happen.
All right, I think we'll call it a day. I'm not seeing anything else. Dan and Mark, thank you. Appreciate you being on. Folks, we'll be doing this again next month. The date on that is July 19th. So be glad to have you join us for that. I'll have the recording for this up later this afternoon and send out an email when that's ready. Thanks.
Thank you,
Thanks, Rich.
folks.
Thanks, everyone. Thanks, Dan.
You too, Mark, Rich.